Algorithmic Forex trading. Code places the trade, not you. But most retail bots quietly die. Here's why.
Algorithmic Forex trading means one thing. Code makes the trading decision, not you. That covers an MT4 Expert Advisor buying Euro USD when the 50 EMA crosses the 200 EMA. It covers a Python script polling the OANDA API every second. And it covers a bank's VWAP algo breaking a $200 million GBP USD order into 4,000 microfills over an hour. All three are algorithmic. The shared feature, no human clicking buy. But here's the split that actually matters, because retail and institutional algos do completely different jobs. Institutional algos do not predict direction. They handle execution, how to fill a giant order without moving the market against you. TWAP slices a parent order evenly across time. VWAP weights child orders to historical volume. Implementation shortfall gets aggressive when the price drifts in your favor. These are routing tools, not opinion engines. They do not decide if Euro USD goes up, they decide how to buy it quietly. About 70% of spot FX volume passes through algos like these, which means the gap between you and a bank is not actually about prediction speed. It is something else. We will get to it. Retail algorithms work differently. At the retail layer, the algo is the strategy. It decides direction. And there are three paths in. Path 1. MT4 and MT5 Expert Advisors. MQL has been the retail lingua franca for 2 decades. You write the logic, you backtest it in the strategy tester, then you push it onto a VPS that runs the chart 24 hours a day, 6 days a week. Huge community, free and paid EAs everywhere. The constraint? You are locked inside MetaTrader's data model and execution flow. Path 2. cTrader's cAlgo framework. Same idea, but the language is C# instead of MQL. Most developers find it cleaner, and the portfolio level support is more natural. Brokers like Pepperstone, ic-markets-pepperstone, and Fusion Markets all offer cTrader alongside MetaTrader. Path 3. Direct API. OANDA, Interactive Brokers, cTrader Open API, REST and streaming endpoints any language can hit. This is where Python with Pandas, scikit-learn, or PyTorch comes in. Full flexibility, full plumbing. You write your own order management, your own error handling, your own reconnection logic. Nothing is given to you. So which strategies actually work? Most documented retail edges in 2026 cluster around 4 ideas. Trend following on the daily or 4-hour chart, buy strength, sell weakness, manage drawdowns through position sizing. Modest Sharpe of 0.5 to 1, but robust across regimes. Mean reversion on majors during the Asian session, when liquidity is thin and the New York close drift fades. News pause or news fade, and honestly, just avoiding the 30 seconds around a scheduled release is itself an edge. And carry trade strategies with risk on, risk off filters. Long high yield currencies, short the funding currencies, exit when the volatility regime flips. What does not work? Scalping bots promising 100% monthly returns, and grid or martingale systems, the ones that double position size after every loss. They look incredible in backtest until the first sustained trend, then they wipe the account in a single afternoon. The math does not survive a one-way market. Which brings us to the hidden killer. The single most common reason a profitable backtest loses money live is under-modeled transaction costs. 4 buckets you have to model honestly. Spread, not the brokers from 0 pips floor, but the realistic median for the session you actually trade. The London-New York overlap is dramatically tighter than Tokyo afternoon. Commission, $6 to $7 round turn on a raw account at ic-markets or Pepperstone. Add it to every trade. Slippage, typically 0.1 to 0.3 pips on market orders, far more on news. The backtester usually does not model slippage at all. And swap, overnight financing on positions held past 5 p.m. New York. Here's the edge math. On a 5-pip target strategy, a 1.5 pip realistic round trip cost is 30% of your gross profit. Half a pip cost is 10%. A backtest assuming 0.1 pip spread and 0 slippage often shows a beautiful edge that completely disappears once you plug in realistic numbers. That is the trap. The edge was always hiding inside the cost assumption. Then there is infrastructure, the part nobody talks about. A serious algo setup runs on a VPS, not your home laptop. Amazon EC2, Vultr, or a Forex specialized host like Beaks or forex-vps, $20 to $40 a month. Windows Server for MT4 and MT5 because those platforms only run on Windows. Linux for direct API setups. You need Telegram alerts on every trade, open, close, and error. A daily P&L summary email. A watchdog process that restarts the EA if it crashes. And ideally, a second VPS in a different region as failover. This is the part most retail traders skip, which is exactly why their bots disconnect during a major news release and miss the move the strategy was built to catch. Broker fit matters too. You want a raw or near raw spread account. Explicit permission for EAs and APIs in the terms and conditions. Low commission, ideally $3 to $4 per side. Scalping permitted. Check the specific account, not just the brand. And for direct from code work, a real fix or REST API. The shortlist is consistent. ic-markets-pepperstone, FP markets, Tickmill, Fusion markets, OANDA, and interactive brokers. Avoid market maker brokers that prohibit scalping or routinely B-book your trades. They are a structural mismatch for systematic strategies. Here's the realistic 6-month plan. Month 1, learn your platform. Strategy tester, MQL5 basics, or Python with the OANDA API. Run trivial test EAs that do nothing real. Month 2, code one specific idea. Keep it simple, 2 entry conditions, 1 stop rule, 1 exit rule. Month 3, backtest properly. Walk forward across at least 5 years, multiple parameter sets, realistic cost modeling baked in from the start. Months 4 and 5, forward test on demo, then on microlot live for at least 60 trading days. Month 6, if live results match forward test within tolerance, scale to normal size. If not, stop and re-research. Do not push through losing forward results hoping live will save it. It will not. So, the verdict. Earlier I said the gap between you and a bank is not really about prediction speed. Here's what it actually is. Institutions do not try to outpredict the market. They spend their entire effort on execution, on routing, on slippage, on costs measured in fractions of a pip. That is where their real edge lives. The retail mistake is assuming the algo itself is the edge. It is not. The edge is a small, durable strategy plus honest cost modeling plus real infrastructure plus the patience to test for 6 months before you scale. Get into algo trading if you are willing to treat it as an engineering project. Walk away if you wanted set and forget. That is exactly what does not exist.
Algo trading rewards engineers, not gamblers. Build small, test honestly, scale slowly. Full breakdown linked in the description.